Hello, learners. Welcome to our session today. My name is CPA Ringo Frederick. In today's class, I want us to do a revision for, that is, of course, financial reporting and analysis. And the concept of discussion today, I want us to discuss about this concept of consolidation, or also referred to as group accounts. Group accounts. I know anytime you feel like you want to do consolidation, ideally you normally tend to look at it as an elephant, right? So in our session today, I want us to handle in a way that you kind of see it as a squirrel, right? Like a very simple concept that, of course, you can handle anytime. And the question that I will be revising on, of course, is a block model paper of ours, which I wish you guys to download this paper just below this video. I've attached a link which you can download this paper just below this video. So we are talking about consolidation. And consolidation, basically, before we go to that question, I want to give you some key concepts that must always be at your fingertips anytime you're handling consolidation. I know key question that all of us always ask ourselves is that how can we do consolidation within 36 minutes or within 40 minutes and everything is done? I'm going to give you a trick that if you use this trick, you'll find that it will always be very easy for you to handle consolidation within the shortest period time available. So these are the key elements that you must always tend to have anytime you're dealing with consolidation. You must be able to know very quickly to determine component of goodwill. This is very key. And ideally goodwill, I normally tend to instruct my students that they should always know how to determine this. And of course, we normally tend to talk about goodwill as what? As our cost of investment, minus our net assets on acquisition, net assets on acquisition. These are very important for us to understand. And the key question is, how will you determine your net assets on acquisition? I know majority of us probably have been taught of cost of control account, right? Majority of you, maybe where you are taught of cost of control account. But today, Mwalimu is going to show us a shortcut, a very simple shortcut on how to determine the goodwill. So after that, the next question that you should ask yourself is how do you normally determine our net assets on acquisition? Net assets on acquisition. How will you determine your net assets on acquisition? Again, you'll find that this concept will always be very simple. For us to determine our net assets on acquisition, we should be able to have this in mind, that you will be considering in the books of the subsidiary always focus on these elements, which will include ordinary shares, which will include the aspect to do with the share premium, if at all you are having any share premiums, which will include the aspect of pre-acquisition. You need to determine your pre-acquisition profits. Then you should also be able to determine and consider your revaluation adjustments. Once you have this, my good student, at the back of your mind, which will give us our net assets. So this will be our net assets on acquisition. And here it will depend with the method that you're using for goodwill determination. If at all we are using the full method, of course, I'll be considering both NCI and the parent company. But if you are talking of a partial method, ideally, I'll be talking of only the parent company component of goodwill. So these are very important for us to note. So after we have noted out, we determine our cost of acquisition, you'll see it to be very, very simple. When we'll be handling this question that Mwalimu wants us to handle today. So these are one item that we should always be able to understand in working out our consolidation questions. The other key element that you should also be able to understand, my good student, is at this point, you should be able to work out our retained earnings. You should be able to determine our retained earnings to be reported, retained earnings to be reported, retained earnings to be reported in the statement of financial position in the SFP. Retained profit to be reported in the statement of financial position. So, key question that we should ask ourselves will be, how will we determine our retained earnings? That will be a very, very important question that we should always tend to ask ourselves at any given point in time, how to determine our retained earnings. This will be simple because what you'll be taking, we start with aspect of course, we are looking at the parent. So number one, I'll be talking of reported profit, or rather reported retained earnings. Talk about reported retained earnings, the one that you have been given in the paper. Consider your share of post-acquisition, your share of post-acquisition profit. This is at all if you're talking of subsidiary. Then also consider your share of post-acquisition, your share of post-acquisition profit, if at all we are talking of associate, right? So these are the items that we should be having in mind always. So I'm having that. Then, of course, at this point, we can also talk about the other key element of what? Impairment of goodwill. Impairment of goodwill. Of course, also for joint, you can also have it there if at all you're dealing with joint, if you're having a joint venture as well. So impairment of goodwill, in that case, you're going to deduct. So that as at the end of the day, my good students, what I'll be having here as our retained earnings, I should be having it at that point. The retained earnings to be reported in our SFP. When we look out this question, we'll find that how easy it is to compute that. Then another key element that, again, we must always tend to have at the back of our mind is how to work out our NCI, right? How to compute our NCI. NCI to be reported in the statement of financial position. How will you compute the NCI to be reported in the statement of financial position? Again, this one will also be very simple. How will it be simple? Because, my good students, at this point, what we are going to consider here are the following. Number one, talk about the fair value of NCI that you're given. Fair value of NCI that we are given. Come and consider your pre-acquisition. Pre-acquisition. That is not pre-acquisition, but post-acquisition. So we talk about post-acquisition profits. That is, of course, share of post-acquisition profit. You should be having it at that point, okay? Then, of course, you can also talk about another element here, which we are referring to as aspect of if at all I'm having impairment, if at all you're having impairment of goodwill. Share or impairment of goodwill on NCI. That one you have to deduct. So that at the end of the day, as simple as that, my good students, without using any cost of control, that should give us our NCI to be reported in our statement of financial position. These are simple tricks that if you're having them, even your workings will always be very, very easy to handle. Even your workings will always be very, very easy to handle. Now, assuming at this point, I've also invested in an associate, right? So about, you need to determine the investment in associate to be reported. Investment in associate to be reported. Investment in associate to be reported. Investment in associate to be reported in the statement of financial position. Again, you'll find that this will be very easy. Because our task here will just be to determine what I need to report of course, in our SAP, what we need to report in our SAP. So this will be very simple because what we'll be looking at here, I'll be talking over the cost of investment. So about our cost of investment in associate, cost of investment in associate, cost of investment in associate. I'll be having it at that point. The other key element that we can talk about is basically the share of a parent company, the share of profit attributable to parent, attributable of course to parent company, attributed to parent company. Then, of course, at that point, in the event that you are having any form of impairment of goodwill, because at times you can have impairment of goodwill, I'll also be having it at that point where we will always be required to deduct, that amount. So that as at the end of the day here, my good students, what will give us here is basically the talk about investment in associate that we are going to report in our SAP. Investment in associate that we are going to report in our SAP. So these are the major workings that you'll find yourself doing, assuming that UPS and realized profit, you know how to work it out, and realized profit on closing inventory, and unrealized profit on fixed assets. Unrealized profit, of course, on fixed assets. So you'll find that once we have this in mind, in terms of our computation, things will be very easy on our end. Then, after we have done that bit of a summary, let us proceed and look at another key element that you must always be very good anytime you are talking of consolidation. Assuming that all of us, we have this, allow mwalimu to erase here, and we analyze another component that is always very key. As we've said, that I believe by now we are very good in computing UPS and realized profit. And realized profit on closing inventory is always very simple because we just need to look at this point, the transaction that we are doing amongst ourselves. That is, at this point, talk over UPS, maybe for the purpose of those who wish Molimo to go through this, and realize profit on closing inventory. First of all, this is profit on goods that have not been sold. They are still in store. In this case, we can have it in two manners, and realized profit, you can always look at it in two perspectives. There's an upstream transaction, and there is, number two, downstream transaction. There is, number two, downstream transaction. So, how will this affect us? In this event, when we are talking of upstream transaction, is simply the transaction that happens in this case. I'm having a parent company here. and you're having a subsidiary. You're having a subsidiary here. Subsidiary, you're having a subsidiary at this point. So upstream will occur when subsidiary is selling goods to parent company. And at this point, what we should always have in mind is that I'll be having two components to be affected. Actually, the retained earnings twice, retained earnings with parent share, and the component of NCI, which you are going to debit. And of course, you are going to credit the full amount with, we're going to credit the full amount in inventory. So this is an upstream transaction. Subsidiary selling goods to parent company. Then we also have a downstream transaction. Downstream transaction is the other way around, just as the word suggests. I'm having a parent company here, and you're having a subsidiary here. So a downstream transaction will occur when the parent is selling goods to subsidiary. At that point, I'll be having what you're referring to as a downstream transaction. So downstream transaction, how to treat the UPS in downstream transaction is that I'll only be having the retained earnings of the parent and inventory only. At this point for downstream transaction, you'll find that NCI will not be affected by that UPS. NCI will not be affected by that UPS, of which I believe all these items, we had covered them earlier on in our coursework. We had covered them earlier on in our coursework, because the whole idea of today, we're just looking at what? We're just looking at our revisions. So once we have that in mind, my good students, once we have that in mind, the other key element that we should be very good at, is for us now to be able to have this in mind, that working out consolidation will always be considering line by line basis, adding our items on a line by line basis. That is to say, at no any given point will you ever take other items of associates and other items of joint venture. Whatever that will be adding on a line by line basis will just be the subsidiary and the parent company. Just be the subsidiary and the parent company. That is very important. That is very important to note. That's very important to note. So once we have this summary, then you can proceed and look at this question of hours. Which Mwalimu will want to revise today. This is our question. It is in our block model paper. This is basically question number 5. In our block model paper, it is question number 5, part B. Which I believe all of us are able to see this question of ours. As I mentioned earlier on, you can download this question. I've attached a certain link just below this video, which you can download. So basically, these are what you're asked. Of course, the first bit, this one I gave you the solution to that, where you are asked interest in the context of international accounting standard, interest in joint ventures, discuss 3 broad types of joint ventures. I've given you that solution. Come to part B. You're told that the following is an extract of the financial statements of A Limited and B Limited, A Limited, B Limited, and C Limited for the year ended 30 September 2021. The good examiner here has given us our income statement for the year ended 30 September 2021. And also, we are given our statement of financial position as of 30 September 2021. So once we have that in mind, we proceed here. These are what you're told. That additional information, we are told that number 1, A Limited acquired 40% of C Limited on 1st October 2021 for 700 million. My good students, also what you should always have in mind is that the date factor is always very important whenever you're talking of consolidation. The date factor is always very important whenever you're talking of consolidation. So here we can see A Limited acquired 40% of C. That is, of course, if it acquired 40%, ideally it will, meaning that we are going to take that as an associate, because shareholding is between 20 to 49%. So that is an associate. So at this point, you can agree and say that C was an associate of A. Then proceed on the same. These are basically what you are also told that these are also what you are told that A Limited acquired 80% of the ordinary shares of B Limited in 1st January. So I'm having A Limited acquiring 80% of the ordinary shares of B. So definitely that will make it to be a subsidiary because you're talking of a shareholding of more than 50%. So ideally that should give us what? Our subsidiary. That should give us our subsidiary. So at this point you can agree and say that B is basically a subsidiary of A. Note 3. The fair value of B Limited's property, plant, and equipment on the date of acquisition was 210 above the book value, with exactly 5 years remaining on the useful life of this property. So basically, at this point, we need to have revaluation adjustments, which at this point, I'm having an item which was recorded less as it was supposed to be. So that is to say, at this point, there was a depreciation which was not taken into consideration, which will have to take that depreciation first and also adjust what with this revaluation adjustment. So clearly here we can see that that item, it was in excess with 210. So I'll be having 210. Its useful life that had remained, we had exactly 5 years. So you can agree and say that depreciation that I should be having is 42 for the whole year. But date factor is always very important. You need to consider, when did you acquire that? When did you acquire that? When did we acquire our subsidiary? This is what you're told for. During the year ended 30th September 2022, B Limited sold goods to A Limited for 40 million. B Limited marked up the goods at 16 2/3 on cost. Half of the goods remain in the stock of A Limited. Half of the goods remain in stock of A Limited as of the year end. So ideally here, my good students, so you can clearly see without doing any form of working, we are talking of what? Unrealized profit. We sold, these are intercompany sales. We sold 140, but out of 140 that we had as intercompany sales, we had half of the goods which were still in store, which ideally is 70. And the goods were marked up by 16 2/3% on cost. So always, what you must always tend to have at the back of our mind is that at this point, this is a 16 2/3%, this is a 16 2/3%. So ideally, what you must always tend to have in mind is that having sales and markup, they can't go hand in hand. So we must convert our markup to margin. We must convert our markup to margin. That is very important to note. Then these are what you're told, note 5. So I'll be having UPS there, which you need to determine. Note 5, as of 30 September 2022, A Limited owed B Limited 80 million, while C Limited owed 15 million. So you're looking at intercompany balances, which they have to be eliminated in our books, okay? Note 6, goodwill was impaired as follows. B Limited 25%, C Limited 10%. The required year, we're supposed to work out, prepare the following financial statements in the books of A Limited for the year ended 30 September 2022. Consolidated statement of comprehensive income, statement of changes in equity, and statement of financial position, So that's the question that you're having, my good students. And I believe you've downloaded this question because I want us to go hand in hand. I want us to follow each other and work it out together. I believe you have downloaded the question. If not, kindly go on this video below and download this question of ours. First thing that we need to do is for us to compute our goodwill. Or you can better still prepare your format. If at all you want to work it out very easily, what you can do, you can prepare the format, so long as you're having the format at the back of your mind. Always do this. This is for the purpose of exams actually.